Thank you. All right, good morning and welcome to today's EITF meeting. First, just want to thank everyone who's able to join us live here today in our large boardroom today, as well as everyone who's able to participate virtually. I do want to just welcome Angie Storm, who was appointed to the EITF last month. She took over the role of Chief Accountant at KPMG from Bob Malhotra, who's moved on to a new role within the firm. So we are certainly very excited for Angie to be able to participate today in our EITF discussion. And we also do want to thank Bob for his role and for his all of his time on the EITF. Actually, Bob had been on the EITF twice. So we welcome Angie Storm to the EITF. Fantastic. We're very excited to having Angie join the EITF. And Bob was not here today, but certainly do thank him for his service on the EITF. In addition, we are joined by Rich Jones, chair of the FASB, as well as FASB staff members, including Alana Armstrong, who is our new EITF coordinator. And we do have observers from the SEC's Office of the Chief Accountant, from FINREC, and from the PCC who are able to join us today. So thank you very much for that. Today, we do have one issue to discuss, which is the application of Topic 715 to market-based cash balance plans. So for those of you who may be watching online, the discussion materials are available on our website and do include background on the issue and the questions that we're going to be discussing here at the EITF today. Before I hand it over to Paul, who is our EITF lead member on this issue, just a few reminders that if you are participating virtually, please use your raise your hand function if you do have a question that you would like to ask or a comment that you would like to provide to the group. If you're in the room, please feel free to just physically raise your hand. And if you really want to get our attention, certainly just give us kind of goalposts and we'll come back to you immediately for you to be able to provide your perspectives. So with that, with no further ado, Paul, I will hand it over to you.
Good morning. And before I get into the EITF issue, I do want to ask the FASB to update their records. I think I've now set the largest gap between leading an EITF issue. I last led an EITF issue in June 14th, 2007. So it's a pretty large gap, but I'm glad to be back at the table again. So EY submitted an agenda request earlier this year to address the measurement of the benefit obligation for market return cash balance plans. Just for those that are listening online and at the table, I do want to acknowledge one thing, that the alternatives that were in the agenda submission have changed over time. They've changed because we did outreach during the process. We had a non-public education session and we discussed the matter with various task force members. And so if you're looking at the agenda request, it doesn't line up exactly with the issue summary on the website. So we just wanted to acknowledge that. A summary of the issue, or summary of market return cash balance plans. In a market return cash balance plan, an employer establishes and tracks a hypothetical account balance for each plan participant. The account balance grows each year as the participant earns principal credits and interest credits. These credits are defined by the plan document. Principal credits are typically based on a percentage of the employee's earnings. Interest credits are based on market returns. While market return cash balance plans have economic features that are very similar to a 401k defined contribution plan, they are accounted for as a defined benefit plan under Topic 715. Under the guidance for defined benefit plans, employers are required to measure the benefit obligation annually using actuarial methods and assumptions. At a high level, this involves making assumptions about retirement age and life expectancy, amongst others, to project the future amounts expected to be owed to the participant at retirement. An appropriate discount rate is then applied to discount the projected benefit back to the present value. The lower the discount rate, the higher the present value of the future obligations. So what is the issue? The issue is actuaries will generally make a best estimate of the discount rate using the rate of return of high quality fixed income investments, which are less risky and therefore lower than investment returns on assets underlying market return cash balance plans. This results in a benefit obligation with a present value that is generally greater than the accumulated hypothetical account balance that I mentioned earlier. The accounting does not reflect the economics of the arrangement and has therefore dissuaded entities from implementing market return cash balance plans over the last several years. In the issue summary, we propose two potential solutions to fix what we believe would provide more appropriate accounting. First, we have Alternative A. Alternative A uses the existing defined benefit accounting model in subtopic 715-30 and it would provide for employers the ability to use a discount rate equal to the interest crediting rate in measuring the benefit obligation. In order to codify Alternative A, we would include a definition of a market return cash balance plan in the master glossary and then modify the codification to describe how the discount rate would be determined for these plans. The proposed definition in the master glossary is informed by language that exists in both ERISA and IRS regulations, and this is perceived to be a more narrow solution to the issue. The existing defined benefit model would continue to be applied as currently codified, and the application of the benefit model would continue to use other actuarial assumptions to adjust the benefit obligation to reflect the impact of preservation of capital features and the election of lump sum payments. Alternative B, as described in the issue summary, the benefit obligation for market return plans would be set to the hypothetical account balance as described in the issue summary. In order to codify this in order to update the codification for Alternative B, we would again define a market return cash balance plan in the master glossary, similar to how we defined it in issue 1 or Alternative A. But then we would modify the codification to include a new paragraph that would require the measurement of the liability equal to the hypothetical account balance. The distinction between the two alternatives really comes down to Alternative A follows the existing defined benefit model and only changes how you determine the discount rate, whereas Alternative B creates an exception to the current defined benefit accounting model. In researching potential solutions, some task force members wanted to know if we could take a more principle-based approach. And so we drafted language in the issue summary, included it in Alternative A. One thing to note about Alternative A is it doesn't have a defined scope. And so all it does is changes the language within the codification to allow greater flexibility for setting the discount rate if there's a market return component to the pension plan. In the end, I'm recommending Alternative A, as I believe this is the best path forward. It fixes the narrow issue, which I believe exists. It is clear, concise, and avoids unnecessary complexities. And finally, before I turn it over to the task force for questions, I do believe that this meets all of the relevant agenda criteria for the FASB to add something to the agenda. I do believe there's an identifiable and sufficiently pervasive need to improve GAAP. There's technically feasible solutions, and there's an identifiable scope. And with that, I will turn it over to the EITF.
Thank you very much, Paul. That was very helpful. And I thought the issue summary was very well done. So appreciate that from a background perspective. So with that, we will open it up for questions and kind of get the conversation started. So do we have anyone who has an initial question, comment that they would like to share with the group? It does. Oh, Dan. Perfect. Thank you, Dan.
Apologies. For these types of plans, how often do we see early termination? And I guess, would that be certainly when someone retires or changes employers? Is it, is it quite frequent, or probably all depends on the cohort, the employee base and so forth? And I guess not that would drive you one way or another, but if there was a tremendous amount of terminations going on, maybe that would potentially lean you a little bit more towards UB.
I mean, we're going to talk in generalities right now, but it's my understanding that there's not a lot of terminations and frequent turnover in these plans.
Brandon?
Well, thanks, Paul. Actually, first, it's a great issue summary. It was easy to follow and sort of absorb. I have a technical question, I guess, to maybe put a fine point on the scoping difference between alternative A and, are we calling it A1 or A prime? A prime. All right, we'll call it A prime today. So alternative A tries to define market return cash balance plans, and one of the potential types of plans is that the return is based on the return on plan assets. And then when I get to alternative A prime, in paragraph 43, it says variable annuity plans can vary on the basis of the investment return of the plan assets. And I just want to make sure you put a fine point on like exactly what the difference is and why variable annuity plans wouldn't actually meet the definition of market return cash balance plans.
So my understanding is, and maybe we need to work on, like, we can work on the drafting. The variable annuity plans don't have sort of a hypothetical account balance. And again, my understanding, and we can certainly research this in the drafting, they don't, there's other criteria in the issue summary. So it's not just the market return, but there's that item B in the issue summary. And so I didn't think the variable annuity plans met those, but we can ask smarter people.
Well, that was going to be my follow-up is that what it was B, that the option includes lump sum payments?
Yes.
Is that also something that might scope out those variable annuity plans?
Yeah.
And then maybe, since my mic's still on, maybe a follow-up. So alternative A prime, opponents to alternative A prime talks about unintended consequences. Do we have an idea of like what exactly those unintended consequences are? Just concerns that there will be future plans that are abusing the ability to use a different discount rate? Or do we have specific concerns about variable annuity plans and the foreign plans mentioned following a approach similar to alternative A prime, that would result in a inappropriate measurement?
So what was raised in our outreach is, concern on A prime because it's more principle based and we don't know what plans will exist in the future. And so, people could then draw inappropriate conclusions when, we're sort of sitting here with a specific plan in mind where we see, the economics doesn't match the accounting, just don't know what's going to happen in the future. So there might be a new plan that people weren't contemplating that's going to fit under this. And then, some people are, I guess, more focused on having a defined scope as opposed to saying, hey, just in general, if it's market-based, you can sort of get this different discount rate. It's not a specific abuse that people are worried about. It's just more the unknown.
David?
Yeah, I mean, and I can kind of answer that. That's a really good summary. It appears to be like what I'm struggling with. I've spent an embarrassing amount of time thinking about pensions lately, and this has come into play. And when you move something to something else that creates this sort of undefined scope, there's all the things about what would I have done differently if I knew something in 20 years. And when you spend a lot of time with pensions, you see that a lot, where anytime something isn't specific, you see things go badly. And I've just been around it so much, so it makes me so uncomfortable. There's not a ton in this that I can currently point to say I've put everything together, I've thrown everything at the wall, and everything seems to work. Like, it seems like if they don't put it in these right assets, they put it in a different asset, I'll know about it because they won't have the return and they won't have the interest credits in the account and there'll be an underfunding. And I see all this. It's just that uncertainty that kind of worries me. And it's a little bit about if there was like an alternative B or alternative A, is the difference just in the work of the accounting, or is there other fundamental differences that we're worried about in choosing alternative A? Do you know what I mean? I understand the B is like more new gap, not just a quick fix. But is there anything outside of that that makes it more challenging?
No, I mean, I think, in drafting alternative A and sort of recommending alternative A, we had an identified problem, we had an identified scope, and we were trying to limit it to that.
Yeah.
Appreciate, Brandon, where you're going with this. It was just more the uncertainty of what might happen in 10 years. And so.
Yeah, because it seems, I mean, overall, the more I think about it, everything, it's just a reverse engineer alternative B, right? To have the discount rate equal the expected amount of return, and that gets us to our service credits and current principal obligation.
The one difference, though, between alternative A and B is a point in time. So if you have a market disruption and the stock goes down, you might have more people that are subject to things like, preservation of capital. You're going to recognize that real time. Alternative A, which exists today, you then, hypothetically, say you have 1,000 people and in market disruption happens, stock drops, you've got 100 people that are now, subject to the preservation of capital. Alternative A, consistent with how the defined benefit model works, is going to say, okay, now you get to forecast when they retire, will the markets return, and you take that number and then you use actuarial assumptions, and you might, out of that, 1,000 or the 100, you might say 10 of them today, we think we're going to have to make a preservation of capital. Alternative B, you're going to hit all 100. And so that is a different, alternative B is going to have more volatility in it in situations where there's a market disruption.
Matt?
So I'll just echo it. I mean, I think the paper was really well done, and it was really helpful to understand the slight nuances of, like, I would say, a more targeted approach versus a principles approach, and then understanding, what types of things might be in that principles approach. I would just echo that, from the unintended consequences, I kind of understood it as, when I looked at this, kind of maybe a concern on, who might misunderstand that they are in this or try to apply it, or what changes might happen in the future. Not any, I would say, like structuring or other things of, like, that don't belong in it, but just more of a potential that people might, read the words differently, where I thought the alternative A was very crisp on what's in there. You've got to have these specific criteria, the words match the regulations, and you've got this redemption option, right? I would say, I'm not real sure yet, the size of the population, the number that you have, if they would say, they might look at this and say, we think this accounting makes more sense for us too. And I think the nice thing with this proposal is, this will go to the board and there's a comment period, right? And, a lot of people will be able to see that and be able to comment on it. And you see what we're trying to fix here, and they might say ours is very similar, and make some types of a recommendation. I mean, we came on a very narrow topic. We're addressing the very narrow topic. The one pause I have is your point on B. Like, I'm probably not in the B camp, because I do think it's more volatility. I think it actually probably, kind of walks away a little bit more from what I would say classical, defined benefit plan accounting would do. It's simpler. It's absolutely simpler, but I would say it's also probably front loading it a little bit, in terms of, like, when you have some disruption and going ahead and booking that now, even though, if you did the more complicated math, like, that's not how you actually expect it to work out. I think all scenarios except for B also capture the potential that you're going to buy an annuity at the end. And I think there's some differential there you need to capture that's not caught in B as well. And so for those reasons, I like A and A prime better. And I probably default to A, because I think it's just crisp of understanding what's in there. And I probably don't have the concern that, there's might be something in the future or someone that misreads this, that. And I'd probably invite the feedback from people that are potentially in that other definition, or look at this and say, this would be a better alternative accounting for me. So it's just my thought.
Thank you, Matt. Angie?
I felt incredibly lucky to have a pension issue be my first EITF meeting. I think There's definitely appeal to view A because it is very narrow and it's answering the question that we've been asked, right, to provide guidance on. That said, my initial reaction was that it did seem a little too narrow, given the words in the standard seem to introduce some judgment. So today's COD, when you read through it, you might argue that there's already some judgment to be had, notwithstanding the fact that practice is concentrated in the bond yield. But there is judgment, it seems to be, in the way the words are written. So because of that, I wonder if there is another path where we don't mess around with scope per se, but maybe include an example of this type of plan. So this is how 3543 could apply in a type of plan like like these types of cash balance plans. And I wonder if that would preserve the COD and preserve the judgment that already exists in the COD, but give an example of a plan that would be an exception to using the bond yield. Because I do think, notwithstanding that we're trying to answer this particular plan, I think there are plans outside the US tax system today that have very, very similar characteristics. And given that the existing language in the COD does seem to give folks some judgment in applying it, I just wonder if that would be another option. I have to admit, I'm not a pension expert, but I super liked View B, mostly because, but I completely acknowledge that sort of breaks DB accounting. So notwithstanding that I sort of like the answer, I'd probably suggest not going that way for that reason.
Can I ask one clarifying question? So in your approach, you wouldn't touch the codification at all. You would just insert an example.
Yeah, Paul, I was thinking more like this is the way it reads. And again, I completely acknowledge that practice is all in the bond yield camp. But is there an option where you say, well, here's an example in which we're applying the already written guidance in a plan where the rate at which the obligation can be effectively settled is a rate something other than the bond yield? I think if we went that way, perhaps you'd want two examples, because to Dan's point, I had a similar question about how often the capital preservation is triggered and how often there's a different option for settlement. And either of those things would change the calculation, change the calculus. So perhaps you'd want, my concern with one example is it's a bit red herring, right? Someone looks at that example and says, oh, it's zero. So I would just be concerned that too many folks would anchor on the perfect offset without proper analysis around the other items that might cause a disconnect.
Okay, thank you. Jack? Oh, sorry, Rich.
Yeah, just question. Angie, do you think that would open up how discount rates are set for all pension and OPEB obligations?
That is certainly a risk, right? Because if you just have an example, I think we could handle that through discussion in the basis, because I do think, and if I look at sort of going through the guidance that's out there, different firms have different examples and different options and different places where they think analogy might be appropriate. We've got places where the paragraphs on the foreign plan, where you have the option to use the normal PBO or the walk away when there is a statutory ability to walk away at the balance sheet date, if I'm reading those paragraphs right. There are guidance in some of the firm's books about times when analogy to those paragraphs are appropriate, notwithstanding that the plan may not be designed exactly like those foreign plans. But I totally appreciate your point, Rich. But I feel like we can handle why we made the change that way and explaining how the task force and the board arrived at that approach. But totally fair point.
All right, Jack?
Thanks. I'd like to just start off by saying I thought it was a really excellent issue summary. It was tight. It identified the problem clearly. It addressed the problem, and offered alternatives that aren't like the solution that at least I prefer, and it sounds like other people like so far. I'm in the view A camp because I thought it created the right fences around the problem. I liked the codification modification, and it seemed to solve the problem without the issue of scope creep. And while I appreciate that, in a principles-based approach like B or even A prime, the modifications to A, that maybe it heads off a problem that we haven't identified yet, but it may never be born. And I think it creates the opportunity for scope creep or more interpretation that could lead to structuring for things that we didn't intend to have. I admire that, but at the same time, I feel like if you go down those paths, when we know what the problem is and try to create a principles-based solution to it, we're going to be back here again because there's going to be a proliferation of different treatments a few years after this goes into the ASC. There may be, I don't know what those differences would be yet, but I never underestimate the ingenuity of financial engineering with the insurance industry or anywhere else. So I just would say I'm solidly behind view A.
Thank you, Jack. Jeremy?
Thank you. I echo the sentiments. This was very well done and very helpful. And I think it makes all good sense to do what we're trying to do here. My one question, and we talked about it last time, and you touched on it before, is just around this preservation of capital. And just from an investment perspective, it's the balance sheet and the funded status and the future cash flows that I'm thinking about the most. And it's in those moments of stress where I'm really thinking about it the most. And I was just trying to understand what happens in that moment of stress. If there is a big market shock, and for some of these plans, the assets are below the principal value. There is this preservation of capital feature where you talk about in paragraph 33, it's the shortfall. It's what's to be expected at the participant's retirement, which I think is what you said gives some leeway to say that shortfall won't be there in the future. But I guess my questions are, number one, I didn't really understand that, because if we're in alternative A, setting the expected return rate to be the discount rate, in that moment of stress, I would think that underfunded status would persist with those assumptions unless there's a change.
So right now, sorry, I thought I was just leaving it on but I did turn it off. I don't know. Somebody just got, anyway. So how the pension model works, and alternative A is not changing this, is you get to forecast when things like when people are going to retire. So if you had a plan of one person and you had a shock to the system and they tripped the preservation of capital requirement, but you didn't expect them to retire for 30 years, you could forecast that the returns would take them out of preservation of capital. And so then you wouldn't have to factor that in. And so when you're talking about large populations, you're going to assume in a market shock, maybe some number of those might trip preservation of capital. if you thought it was going to take the market 3 years to recover, you'd look at the population of people who are going to retire over the next 3 years and make an estimate of, yeah, I'm going to have to make a payment for these, this population. To counter that with view B is just going to say everybody on that date in a market shock is going to be, if they are tripping the preservation of capital, you're going to have to reflect that in the financial statements.
Right.
And which seems, I mean, depending on your view, seems inconsistent with the rest of the pension model, where you do take sort of a longer term and you estimate things like retirement age and all of those things. And so it's sort of a disconnect with the pension model, where this population of pensions, we'd be saying, okay, in certain circumstances, we're going to go away from that. And last thing is this is about the liability. So the assets are a separate determination. And to the extent that there's a disconnect between the liability and the assets, that would be reflected on the balance sheet. But the assets are going to be at fair value.
The how that evolves is where kind of my bigger question is. If there is a significant market shock in view A, and so some people are expected to grow out of it, but some are not, what happens in subsequent years? What are there will be a preservation of capital adjustment in the moment,
right?
How that's reflected the next year or not.
So if in my example, 1,000 people in the plan, 100 are subject to preservation and capital, you forecast that, that 10, you're going to have to make a payment. In the next year, you would just reassess all of your assumptions. And, in that case, maybe the market recovers and everyone gets out of preservation of capital. Like, you just reassess the assumptions every year. And so in some cases, like, if you go back to the great, 2007, 2008, we had a fairly quick turnaround in terms of the market. And so a lot of those people in that time that were maybe subject to preservation of capital probably didn't retire. And therefore the liability, you just keep adjusting the liability every year. So it would, if the market returns, it corrects itself. But it corrects itself through the pension calculation. Whereas view B, you're going to see spikes. View B is going to get very up and down in a market disruption.
I'm just trying to square that with what a defined benefit plan looks like in a market disruption where the assets are, where there is a big underfunded status in a traditional defined pension plan.
But in a remember that in a traditional defined benefit plan, there's still a separation of the liability and the assets. And so if there are components in a defined benefit plan during a market disruption where you think, and we're not talking about a cash balance market return plan, but if you think all of a sudden people are going to retire and you're going to have to start paying out of a defined benefit plan, that gets factored into your liability. And so, but because you have to make those assumptions every year.
Yeah, I guess it's those assumptions where I understand the problems with B, but that more cleanly presents the balance sheet in that way, economically.
Hey, Jeremy, I would add in too, in the traditional benefit plan, keep in mind that the accrual accounting is separate of the funding status. So you could have a market disruption that would trigger additional funding, but that wouldn't necessarily impact the accrual too. So I think that's an important, whereas essentially I think under view B, that would impact the accrual. So there's a closer tie to the funding.
I understand. Yeah.
Dan?
Is under view A, if we have a market disruption and then the capital preservation, would that loss go to OCI under kind of defined benefit accounting, but under view B, it would go to P&L, and the magnitude under view B would be larger than view A, as you've described?
There'd be.
There would be a greater impact in the income statement on View B. And you would see it'd be a greater volatility in the income statement year over year. So as the market returns, you're then going to see, gains effectively. So I'm leaving it on now.
I think that at the end of the day, that's the thing that it's probably most troubling with me for B is you're effectively forcing 100% assumption of everyone's going to redeem when you know that's not what you expect. In fact, it's not going to happen.
Yeah.
Right.
But it's also, we're getting into View B and View A with that assumption as well, that we're using that argument in both camps of like, hey, this is different. And so when it's good and bad, if we're identifying it as different there, and I'm not saying View B is better or anything, it's definitely a very, very difficult mix between information front loaded to me and panicky information that is not relevant to my current cash flow horizon. And it's just balancing which one I want. The only thing I really don't like about View A is and this might not be right, some of the actuaries I see around could explain this to me, but like when you have this market shock and this preservation of capital comes for people in the next year or so, you are effectively paying your underfunding of your pension for the principal amount with the future returns of the people retiring 30 years from now. And under pension accounting, you can't assume the market will pay your debt. You have to take like the risk-free debt. But because you're taking that market return, you assume this market correction in the future, and you effectively move those returns to your principal right now. And that is a little bit not pension-like to me. But at the same time, the other side isn't like a shock to the system of having that go through, because we call pensions debt, and there's a lot of discussion about that because it can be 30 years away, and it's very different. We're always monitoring the cash flow that goes out. We're always monitoring the funding and making sure that they're making their required payments and things like that. So it's always a push and pull with pension accounting, with information versus information that's relevant under your next 5 years or even 10 years. And I can see both sides of this coming through.
Thank you, David. Tom?
Yeah, I agree with a lot of the comments that have been said. I think, in my mind, this all comes around to scope and how do you want to scope the issue, whether you want to scope it in View A or View A prime, I guess that's what we're calling it now. I'd be supportive of either of those. I think for the reasons expressed, View B and the volatility associated with it was not something I'd gravitate towards. To me, the biggest issue is around the preservation of capital, and I think, Jeremy, you hit on it. I think many of the plans we see today, I don't think the existence of the preservation of capital in the design of the plan is significant. And as a result, I'm comfortable with those views. If it was significant or the plan didn't feel more like a defined contribution plan, I'd have a different story. So the example I have is, what if you had a plan where you basically gave someone a 20% return and then S&P above the 20% return? I think I'd look at that and say, well, that doesn't feel like a market-based plan to me. That just feels like a fixed plan. And so we are sort of dancing on the head of the pin of when does hot water turn cold and when does it become a market-based plan? So I even think with A, there's probably some questions there. So I'm not opposed to including examples to maybe, illustrate the point. So that's why I was gravitating towards View A and View A prime. I'm more principles based, so I like A prime. But I think this idea of having some level of significance around the preservation of capital would be important in trying to get the scope right.
Brandon?
One last comment. I want to say the write-up was pretty good.
Thanks, Tom.
I'd like to iterate.
My pension people just went down up. They were really good. They were feeling really good, and you popped their bubble. They appreciate that.
I already said it was good, so I'm going to go to my next question.
All right.
So, and this probably impacts, because I agree with Tom that, I could live with A or A prime. I lean towards A prime, and maybe the answer to this question might get me to A. So, Jack mentioned the problem. A solves the problem. The problem I thought was that the accounting doesn't reflect the economics when you use a double A rate. So the two examples listed that A prime allegedly would scope in, that A would not, variable annuity plans and the foreign collective defined contribution plans. Do we not think that the accounting does not reflect the economics if you did not use a rate that's more consistent with the return on the plan assets?
So on the foreign plans, I don't know because it's literally in 20 jurisdictions. And so I didn't, while I learned a lot about pension accounting through this process, I didn't start going country by country to figure out, because they're not all the same. Some of them end up with commingled assets, and in some cases you're getting like effectively shares. And so I didn't go plan by plan. And even if we use A prime, I don't know that all of them are going to get into A prime, to be perfectly honest. It's a longer list than I realistically understood before I started this process. And so I don't know that it's going to bring them all in.
So let's just say the ones that do come in. So, however this is scoped and defined, do we think the result of applying A prime is inappropriate? And that's what I'm kind of caught up on, is that, at least as it's been explained to me, I will put myself in the camp of Angie not being a pension expert. At least a month ago, I wasn't. But I keep sticking on this issue, which is, if there is a problem with those plans, which I've been told that there is, that using a more consistent market rate would be a more appropriate result, are we just going to A because we're fearful of something else in the future versus the ones that we know exist today that we could get better accounting from?
Yeah, I mean, look, I think some of this is how people view this. I haven't heard as definitively in that the current accounting is wrong for these other plans. And so, and maybe this is a point where we ask a question, and I mean, we can recommend to the board that they ask a question. You seem to have heard very definitively that
I wouldn't say definitively, but at least there's some concerns that these plans would just as equally be more reflective of the economics as the ones that would be scoped in, and maybe that's not an absolute.
Right. In my outreach, I haven't heard the same thing. So, but that's why we have an exposure period. So.
Thank you. Angie?
Yeah, I was just going to tag on to something Brandon said, because most of our folks have identified at least some jurisdictions that have plans that they feel that this accounting would be equally reflective of the economics as US plans. So we've got, blame the Dutch. I think we have a Netherlands plan that I keep hearing all kinds of good information about. But I guess, but I agree. I mean, I think that's a good question for the profession as we go through the comment process. The other thing is, I just reiterate too, I think it would be really good to have an example of a situation where the capital preservation assumption does trigger, because I do think it was hard for me to sort of think through and weigh the options without knowing how it looks when that happens, to the point that this is really complicated accounting, and it's complicated disclosure for folks that don't, well, for even folks that are really good at GAAP, it's hard to sort through. So I do think maybe that would be worthwhile, that I feel like we owe it to the folks commenting to show them what it looks like when the capital preservation does get triggered, just because I think that's a blind spot to drawing a conclusion.
Yeah, we should clarify one thing. The preservation of capital, I left it on. The preservation of capital is only triggered when they retire. So like we're talking about this as if at any point. So when you say an example, I don't would we be writing an example to show when someone retires?
No, I'm sorry, Paul, you're right. I think when you've gotten like in your earlier example, when there's 100 people and you think 10, right? Like how does that play its way through? Because the basis for using the equity rate is that the basket of investments would, if you purchase that basket of investments, they would satisfy the liability. That is not true if you have an assumption that the capital preservation will be triggered for some or not all. So I was just suggesting to show how that runs through the model so that folks sort of know what they're signing up for.
So
It was
they're already doing that. Like, just to be clear, the actuaries are already making that assumption.
right.
And I'm happy to put it in the agenda, but like, remember, they're already making those assumptions today, and they've made them for as long as they've been doing it. And so if we want an example that highlights that specific assumption, we can, but that's already in their model.
But I guess after having the assumption in there, but then layering on top the discount rates, or are they just adding an adjustment? Like, I'm just not sure how it plays through the example, I guess is what I was, and maybe that's just me not understanding the pension accounting as well.
Right.
I think it's really valuable, but I also think it broke my brain to understand this. Like, it's really hard to be like, you have a liability, but the liability's in 30 years and 29 years, 27, 26, 24, all of these different areas. But it may be the only way I could think of doing it is just having a 20-year model of what the liability and what the cash outflow is for a volatile period. And you can see over a longer horizon that here alternative B said I'm underfunded by 100 million and looks like I need to contribute to this, but 4 years later there really was no additional cash outlay to fill that principal gap because of the returns and because everything caught itself up. But outside of that, it's a really tough. Like
This is why the actuaries do it.
Yeah, it was. I mean, I didn't say it was good, but it is good.
Yeah.
But yeah.
Rich?
Yeah, and maybe I misunderstand something, but I always thought the accounting was for the plan, not the individual. And so while we're getting into this discussion of 10 people leave early, the whole idea is you're evaluating the plan as a whole. And that's your unit of account, the way we've done this thing. So I appreciate the examples of one person leaving or not. You're still forecasting out plan. You're forecasting out the accretion of benefit. And then to me, this is fundamentally back to, do you want to accrete the benefit and discount it at the same rate or different rates? And I thought I heard from generally the folks, they want to do it at the same rate. And then there's a good question of who do you want that to apply to?
And I think that's kind of the overarching capital preservation call is we're looking at it individual versus the unit of account is individual on this and it's overall on that. And you get the benefits and the doubts with both sides.
Yeah, that's why I made the statement around the significance of the preservation of capital to the plan overall.
Yeah.
To Rich's point, viewing it at that level. I also think it's important to realize that you cannot come up with the basket of invested assets that would perfectly hedge this liability. It doesn't exist.
Well, you could invest it in that.
No,
thing
even
that
if you
said.
invested in
What
that.
if you said S&P 500 and I put
No,
my principal
well,
in?
keep in mind,
right
if you're doing that,
couldn't do
what you'd have to do actually, because of the preservation of capital and forgetting all of the decisions around when people leave and when they retire, which adds complexity but what you'd really buy is a zero discount bond to cover the preservation of capital, and you'd buy a option on the S&P. The reality is, like, good luck finding options on the S&P that go out 20, 30 years. Like, they don't exist. They'd be extremely costly. And so no one's doing that. They're just buying the pool of the assets, knowing that they'll have this time to recover, the risk of the preservation of capital. That's why I think it all comes down to the substance behind that. And, how significant do you think that is to the plan?
Matt?
I think we have kind of covered this, but I'll just ask it just to confirm. Like, my understanding is, if there was some kind of a market event that happens and, we've got triggered this, whether or not that changes, if people are going to leave and take that preservation of capital or retire earlier, all of that, I just want to confirm, is in the actuarial calculation. Those changes, right? It gets picked up in the balance sheet. Right. To me, the difference between A and B is about what immediately goes to the income statement, whether you just hard code that at 100% or taking the preservation of capital, which again, you know, I get it. And I think there is a risk. I think that's really good, valuable information. David, to your point, you know, part of me also wonders if maybe that's a thing that you need to make people aware of with some kind of disclosure, not saying that you expect that. It's actually not my expectation at all that everyone's going to leave and take that preservation of capital, but it is a thing that's in there. It's part of our assumptions. Like maybe there's a, here's how many we're estimating. If it's off from actual, you pick that up in next year's, you know, calculation, you know, it's going to be off maybe some in any given year because this is a big estimate of the plan in a whole. But I just wanted to, I'm getting a lot of head nods, but you know, I just wanted to confirm that that's how I understand this to work.
Yes.
Jeremy?
To Tom's earlier comments, what is the line, I guess the definition of a market return cash plan? I'm thinking about aggressively invested portfolios, or you know, if a significant amount of a company's stock is in the portfolio or some other kind of alternative asset. It's easier to think about in, we're talking about market return and market rebound, et cetera. But are there enough, is there a good enough definition around what falls into this to allow the preservation of the meaningfulness of the preservation of capital comment to not to allow us to move into view A? For example, if I'd be much more comfortable in view B for an aggressively invested portfolio that falls into the scope because I think it more appropriately reflects the preservation of capital.
I mean, each plan is bespoke, and the investment strategy and the interest crediting strategy is within the plan documents, and there's rules in ERISA and the DOL around what that can look like, and there's guards against that so that you can't have an overly aggressive plan. I am not an expert in ERISA or IRS regulations, but my understanding is there are guardrails. And so, but you know, what companies try to do is they have the plan document that outlines how this will be invested and how you'll have the interest crediting. And so they try to match that up. So I don't know if that answers your question. That's as best I
Relying just on the ERISA structures and those guardrails.
well, in the plan documents.
Yeah. Yeah, I think that's the only risk I can really see in the scoping of going through is we get aggressively high interest rates that are hiding as the interest rate or the discount rate as it hiding returns and having the returns pay the principal and the shock. That's the risk I can see with this going forward. And it's you know, half a point or whatever it is going up and pushing it can make the difference between debt for us and not debt for us. So it is something that is of concern. And if that was not well defined or audited or going through, because we do have pensions around the world that are discounted at a market return and we get wildly different return numbers, not wildly, but more than you would expect in the same market for the same type of liability they're offsetting. So that's the only thing I can think outside of like real doomsday bad actor stuff, which isn't our job to prevent.
Right.
And so, but that would be the thing that I would be most tight about, but I don't know how to rein that in without capping it or something.
Right. I mean, the plan already the current accounting already requires them to make this estimate. This isn't a new estimate. It's just because they're making the estimate going out, and then this would just be aligning the discounting back to the same estimate you use going out.
And they're going to be subject to it because it's in the plan documents, whatever the rate is. It's just the motivation to kick the can down the road is always there for anybody that is never going to be employed by any of these companies by the time the bill comes. And that's the problem.
So maybe just to put a finer tooth example on it, which I think was Tom's, and I think it was really good. That was kind of how I thought about it. So like, let's say you have something that's S&P plus 2 or 4%, and you know, it's really difficult to get that. Right. And, you know, you'd say, okay, well, that's the dividing line. Maybe I don't feel good about that being in this accounting. Right. I wouldn't have thought it would have fit in the first sentence of you could effectively settle through buying something. That would seem like a stretch. And, I thought, Tom, you had suggested maybe you have some kind of examples or you'd kind of do something to call that out as a guardrail. I don't know if there was a thought you had on how we might do it, but, in my mind, I thought, that's the judgment call in those words. And, it could be helpful to include in there, something along that line.
Looking around the room and on the screen to see if there are others that have questions or comments with regards to alternatives A prime, or B. Kevin?
Yeah, I have a question for Paul. Paul, I thought this was very well written. Thank you. I came into it leaning
See,
on,
Tom, see.
leaning on view A, but the questions about A prime and, particularly the foreign plans that have characteristics a lot like the market return plans. Were there anything in the research that you performed that suggested that some of those foreign plans do fit, the scope of what we're trying to solve, and those that didn't, what the defining characteristics between those two types of plans are?
So I didn't tear apart the intricacies of each of the plans. I think it's fair to assume that when we do that, some will fit the characteristics that this represents a market return. I'm sure that some of them, I mean, it was a long list. It was 30 some odd plans or 30 some odd countries. So I think we should assume if we go to A prime, some will meet it, some won't. Where the dividing line is, I don't know.
Brandon?
Do we, you're probably going to say you don't know the answer to the question because you didn't study all 30, but do we think any of them meet alternative A?
No.
And is that because of criteria B in the definition? Participants have the option to elect lump sum payments, or because, going back to my first question, it's like A includes the return on plan assets, and it's like variable annuity plans seem to be a return on plan assets. So maybe those are scoped out because of B, whereas foreign plans might be scoped out because they don't meet some other aspect of the definition, and I just haven't put those plans through A.
Right. Yeah, I mean, I think that logic works.
Okay.
Jack?
Yeah, quick question, since we're talking about the criteria in 40, I think paragraph 40A is where we're talking about. It says including any of the following. Is that any single one? Is that all of them? Is that only those? What would you have in mind there?
It's so those three criteria would be any of them are modeled after the criteria that are included in the ERISA and DOL. So it would be limited to those three, and it would be any one of those.
So Paul, I think wording of based on any of the following would be
Right.
fair. Okay.
Maybe I think I understand. So that means including any of the following, no analogies can be made. We're trying to limit it to that to avoid, because obviously right now, Angie, you made a good point. In the current COD, people are seeing avenues to analogize to different pack patterns to get to the right substance. So this would sort of close any of those analogies that could be made because it has to meet one of these three.
I think, Brandon, it would clarify that for plans that meet any of those three criteria, it would be appropriate to use the discount rate as being discussed. And maybe, Angie, just a clarification on the alternative that you put out earlier, examples rather than kind of going through the COD and making changes from a scoping perspective. Would it be fair to say that that alternative is more of an alternative A1, but done through examples rather than through changes to kind of the scoping language? Because it sounds like it's trying to get to A1. I'm trying to make sure we don't have, do we have another
Yes.
alternative, or is this just a variation of how we would execute alternative A1?
I think that's right, however.
Okay.
I'm not trying to push an A2 or anything.
We love we love another alternative A1
Yeah.
prime, right? Exactly. So, okay.
Yeah, it would just be another way
Okay.
to execute through it. And, I think the bit about when is it okay to analogize, I mean, and not to throw out A3. But I mean, another option, right, if you went with A, would be to try to say something in the basis that the basis on which we rejected A1 was not because we think it's an evil definition. It just, we scoped this project very narrowly, right? So that you're communicating that this isn't, to Brandon's point, we're not trying to close holes in places where the existing guidance already allows judgment. The project was simply scoped very narrowly. And that way it's not communicating that now that we've got this very specific scope means everything else is wrong.
I think that's a good point, Angie, with regards to the way that it's framed, right? I think that could be something that could be clarified in the basis. And, often we do not put in statements saying, and this may not be analogized to, it's actually uncommon, right? When the board puts that in place. And if it's not there, I think that would mean that current reasonable judgments could continue. David?
I mean, just to put out there with the A and the A1, it seems if the lump sum settlement is the divider that brings things in, that seems counterintuitive to the objective here or the kind of economics here. Those are the ones I worry about less that are paid over time. So why would do you know what I mean? So not to have the lump sum doesn't worry me if we identify something that pulls in that is of worry in that way, but I would think this is more representative of the ones it's pulling in than the ones that settle at a point in time.
Yeah, David, you did a better job there, I think, of articulating what I was struggling with, why A1 is not the right answer is I was trying to what about a variable annuity plan? Let's keep out the 30 plus 4 and 5. What about a variable annuity plan is concerning to us? And if the only reason it's not in is because it doesn't have the option to elect lump sum, does that make any sense? Or, yeah, and it's going down the path of, it seems like we maybe aren't concerned, maybe some people are, I don't know, we maybe aren't concerned necessarily with a variable annuity plan, but we are concerned with the open-endedness of scope that's not tightly scoped.
Yeah, and that's, I mean, very fair. But it was, just the comment that I'm not, if the things that are on the table, I'm not particularly worried about them. And I think the argument would be the ones with lump sum would be more troubling to pull into this accounting, because they have a lump sum and not overtime to rectify some of these discount rate anomalies.
And Paul, when you guys are coming up with the criteria, right, keeping in, and I believe it's 40B, right, the ability to elect the lump sum payments, that was intentional, right, for including as part of this? Because it sounds like, right, there's maybe some interest in whether that is or whether that does or does not need to be a criteria.
Can I see paragraph 40 for a second? I just want to confirm one thing.
And I'm not saying it definitely doesn't make it easy, to expand and have something open-ended. So I'm all for targeted for the ones that exist.
The other piece of the definition that might prove challenging on the variable annuities, because the variable annuity plans are not cash balance plans. They don't meet the legal definition. In 40, we say in the form of a current account balance. So legally under ERISA, in the variable annuity plans, they don't have a current account balance. So it's not, variable annuity plans are going to be, they won't meet this definition for multiple reasons. Not just that, not just the one we were talking about. So.
Thank you, Paul. And I think that's an important clarification, right? Because as you start to parse the different criteria here to see if you can meet, certain plans can get into or out of, I'm a little concerned that we maybe start to put a little bit of a Frankenstein monster in place for plans we don't know all of the terms of what's, what's concerning us versus not, which I think is just ultimately the concern with regards to, or the different views with regards to alternative A and A prime.
And it's not a concern for just A
Yeah.
to let this in with this
Right.
sort of
Yeah.
open-ended side. So I understand that.
All right, are there other questions or comments on the alternatives? Dan?
Yeah, just a quick thought. With some of the features we described where if the return on the cash balance plan were, 500 basis points plus the S&P, you could almost, from my perspective, look at that 500 basis points. If there's not an asset that can provide that, maybe that's just part of like the principal crediting rate or something that you would expense as you go, carve that out, and then you get back to, the S&P. But and probably those plans may not exist out there today anyway. From my perspective, just hearing, the various views, I'd say very supportive of view A for the reasons described. And think, if we included a question, if the board decided to constituents to identify, what problems are not being solved, how big is that population that's been suggested, that would be informative. I think Matt's idea on a potential additional disclosure as well, as far as what's truly underwater, at the balance sheet date, if that's concerning, but that's a dynamic that exists in plans, today. So.
Appreciate that, Dan. Yeah, and I think Dan took us into voting. So unless anyone has any other questions or comments with regards to the alternatives, I'm happy to continue that pattern and see what we have from initial perspectives. So I would say it's alternative A as drafted in paragraph 40 of the issue summary. There's alternative A prime, I believe we're calling it, right? Alternative A prime. And then if you are alternative A prime, I'd appreciate if you would say you're supportive of A prime as drafted in the issue summary, or A prime through examples as Angie had indicated as a potential way of executing that earlier, or if you're alternative B. So that would be great to see where we're at. We can go around first and see if we can get a majority. So, all right. So Dan went. So let's go from there. So Jeremy, I have you go next. Thank you.
I'm good with alternative A. I have some concerns about the preservation of capital, but no more concerns than pension accounting as a whole, which is not the model of economic representation.
Appreciate that, Jeremy. Okay, Matt?
I'm view A as well.
Perfect. Angie?
Microphone.
Ooh, can you push the microphone, Angie? Thank you.
I would prefer A1, but I wouldn't object to view A. And I think either alternative would work. Alternative to A prime, I sort of like the example option a little bit better.
Yep. All right. Kate?
I'm view A. I don't object to A prime. I like the suggestion that was made to ask a question to really flush out the potential impacts of an A prime example.
Thank you. Tom?
I could support A or A prime. My heart of hearts tells me I'm an A prime, probably an A prime Angie. Congratulations. But I would support either view with the idea that the board could move forward with a question around scope, which I think could be really informative around whether we're heading down a direction we wouldn't want to head.
I think that's fair. Absolutely. All right, Paul?
So I'm in view A. A prime, I'm fine with, and I think we should ask questions about A prime. There may be plans out there. And so the piece sorry, Angie, I don't love the idea of just doing examples. I don't think that's going to work. I think that's going to cause us more problems. I think we need to put some codification amendments in there to describe it. If you don't like our A prime, happy to have other people draft it. Don't take a bunch of pride in authorship, but I do think there needs to be codification amendments if we're going to go to an A prime. I just don't think its examples are going to work.
Thank you, Paul. Jack?
I'm with view A. I think, like Jeremy said, it gets you closest to the existing pension model that we have. Maybe it's not the best pension model that we could have, but we're not gonna revamp all of pension accounting here. And I like the scope. Wouldn't object to A prime, but I'm more in favor of A. Anti-B.
Perfect. Thank you, Jack. Brandon?
I would vote A prime, very similar reasons of Angie and Tom, but I also don't object to A. I just keep coming back to, if we took the things that are in A prime and we put it up of what's throwing it out, I'm not sure the reasons that it's out are good reasons not to be more consistent with the economics, but looks like we're going to expose A and ask questions about A prime, but I will throw out my vote for A prime.
Thank you. David?
Yeah, pretty similar. I wouldn't object to A prime. I understand it's a lot of work. It might be more, I'm more curious about A prime than what else is out there that we're looking at and maybe incorrectly classifying on the balance sheet. Maybe not incorrectly, but not representative of near-term economics that are going through that we're seeing and picking up in here. So I'm okay with A prime or just A. In A prime, I wouldn't object to, but I think that's a little bit more legwork to get that one done.
All right. Thank you. And Kevin?
Yeah, I'm view A. I think it's responsive to the question submitted in the agenda request. The accounting reflects the economics, and I think we can deal with the scoping through the questioning when we expose this.
All right. Thank you very much, Kevin. It looks like we have a majority for view A, but also seems that there's support for asking additional questions, right? For the board to ask additional questions.
And on the additional questions, if they're going to open it up, but the disclosure things on the preservation of capital disclosures, like those were really good points to think about when, especially near-term cash flow pulls on that preservation of capital. But I don't think, as Jeremy said, it's any different than a normal pension, but the disclosure would help both on that near-term cash flow horizon commitments that they are expecting.
Appreciate that. And I think we can certainly bring that to the board as part of the discussion. I think it'll be right considering the scope of this issue and whether or not broader pension related disclosures are something that the board's interested in doing in this project, or if it's feedback for other things through agenda consultation, maybe a good place for it. All right. So looks like we have Jack?
This may be something to follow
Microphone.
up on. but-
Jack, microphone.
This may be something to follow up on, but I believe the pension disclosures already have some minimum cash outlay disclosures related to the minimum ERISA requirements, which would be presumably what would be paid that we would think about too. So
I don't know that I've seen them, so I would be.
They do have the minimum required, which is usually not what happens. Like it's required by ERISA, but those are not so helpful.
I think it's fair feedback for us to take back and think about if there's ways for that to come back to the board. All right, so we have made it through view A. So that takes us through question 1. So maybe if we can move on to question 2. I think we've done the hard work. So thank you, Paul, and thank you, everyone. Very good discussion here. I think that helps solidify views today. So with question 2A, question here is whether or not the EITF agreed that this recommended approach should apply to all entities. So I think here looking for any feedback from any of the EITF members with regards to, is there any reason why this should not apply to, other than public business entities? Is there anything that would be helpful from your client set to help us understand if there's any differences from a private company perspective that we should think about? I'm just looking around the table. If there's any questions or concerns, comments?
I would think it would be more valuable for them.
Okay, thank you. Matt?
No, I'd say these are quite common outside of public companies, so I think that you definitely would want it all entities.
Okay. Just seeing if there's any questions related to question 2A. If not, I'll ask for a vote from question 2A, or do you agree that this should be recommended, the recommended approach should apply to all entities? I would, based on I'm reading in the room here, it doesn't look like I need to individually call on votes, maybe raise show of hands and those on the screen if you agree this should apply to all entities. Okay, I'm looking around the room. Matt did raise his hand. So, okay, we have a unanimous decision on question 2A that this should apply to all entities. So we can move on to question 2B, which is whether or not the EITF agrees that entities should be required to apply the recommended approach versus having this be an option. First, I want to see if there's any questions or comments with regards to this question, requirement versus option. The recommendation, I think, is written as a requirement. Is there anyone who has an interest in this being an option? All right, looking on the screen as well, Kevin, Jack, and Kate. Okay, so by raise of show of hands, do you agree that this should be a requirement? And Matt has also raised his hand. So we have a unanimous agreement on question 2B, that this is a requirement. And then for question 2C, this was a question of whether any additional disclosure should be required or not required. I think this question was intended specifically related to the discount rate being used. I know that there were some questions that have been brought up with regards to broader questions about pension accounting in general, but wanted to see if there's any additional feedback with regards to questions specific to this more narrow issue. If there's anything additional that folks would like to bring up. David?
It's still in scope of the other pension disclosures, right? So
Correct.
the ones that are Jack's mentioning will feed into this,
Absolutely.
even though it's not an ERISA requirement. It's a maybe required principal funding next year in cash flow. That would be scooped into it, right?
That is correct. All of the existing pension disclosures would continue to be applicable. I think the question here is there anything incremental that is necessary? All right, looking around the room, no questions, comments? Brandon?
Just a quick comment, maybe, and maybe it's just in the basis, or maybe it's just obvious. I mean, there's existing disclosures when a rate is significantly different. So I don't know if we acknowledge in the basis that if you're going to use, if you have a market-based plan and the rate's significantly different, that could be subject to disclosures in, I think it's 715, 30, 35, 45.
I think that's a good point, Brandon. We could certainly make sure that it's clear in the basis, right? Existing disclosures will continue to be applicable, and in certain cases, those may be come into play in these type of transactions.
Just this,
David?
I don't know it well enough, but will we get the rate, like if they have a significant plan on this, or will it get blended into a discount rate with other pensions around the world or normal defined pension plans?
Well, that's what kind of the disclosure paragraph I was just reading is that it could be blended if it was not significantly different, but if it is, companies are supposed to disclose that. So,
yeah. Okay.
Jeremy?
Just to follow on that, the discount rate will be the return rate, which I think could be significantly different from the normal discount rate.
That's why I was pointed in the basis is
different.
that if we observed in the basis that this very well could be a situation where it is significantly different. I mean, it might not be, but it probably will be.
But are you saying that by blend, do you mean we'll still only have one discount rate, or will we have the discount rate for the traditional benefit plans and then maybe this particular rate?
Should we just recommend that they separate it so that they don't have to evaluate significant?
Yes.
So just to be clear, there's a disclosure requirement today on your different discount rates, right? And if they're widely ranging, sometimes companies disclose ranges, they disclose different things. Do you want to do something different just for this rate versus they could have widely varying rates elsewhere? Particularly if you follow the approach that you think this is already permitted under current GAAP and all you need is an example.
I just wouldn't want this rate, if it's high because of the strong market return, to make the discount rate look very high on the remaining.
Well, it seems like it's a completely different methodology around development of the rate. So I would have thought, like yours, Brandon, it would have been significant. You'd have to break these out. I guess if you had multiple market-based cash balance plans, you might be able to aggregate those, but
I think
so I think
breaking it out.
so it is, just
What-
because the rate might end up not being significantly different, the methodology behind the rate is certainly different, right? But I don't know.
I think we could certainly also ask a question with regards to if any additional enhanced disclosures would be necessary as part of an exposure draft, if the board takes this project on, which I think would be fair. Okay. So any other questions or comments with regards to disclosure? And so I will ask for a vote of, does the EITF agree that additional disclosures should not be required related to this specific issue at this time? And by show of hands, do you agree no additional disclosures for this particular issue? I'm looking around the room and on the screen. Jack, do I have a, nope, okay, Jack is not voting for no additional disclosures related to this specific issue. So we, I think, have a 10-1 vote on issue or on question 2C then. Perfect. Thank you. All right. So that takes us through, but we will ask a question. If the board decides to take this project on, that seems like a good question that we can ask as part of the exposure draft process to make sure that we get feedback from stakeholders. So with that, I will move to transition and early adoption. So we have a question 3, which is whether the EITF agrees that transition to the amendments discussed should be applied either retrospectively or prospectively, and if early adoption should be permitted. So looking for feedback here from the task force members of whether there are any specific views of whether this should be able to be applied retrospectively and prospectively, if that should be an option for entities, if there's any reason we should not permit retrospective application or prospective application, or if folks are comfortable with suggesting to the board that either retro or prospective would be acceptable, and if there's any particular views of why early adoption would not be permitted. So I'll open it up to the EITF members. Brandon?
I have a question about what we mean by prospective. So do we mean like modified prospective where the cumulative impact of measuring anew based on this different discount rate would go through retained earnings, capturing some in OCI, or do we really mean prospective? So if a company is an immediate recognition, they use this new rate and it flows through the P&L, which seems slightly concerning to me. Normally when we're talking about perspective, you would think of new transactions or future changes. This is going to have a cumulative catch-up impact. I went back to FAS 158 and they did, modified perspective for certain changes to pension accounting. And so I just want to make sure I understand what we mean by perspective.
I mean, I can tell you what I meant, and you all can, maybe I didn't get the right words. Remember, I haven't done this for a while. So we were just asking the task force. There's one view where you say you have to go back to the beginning of the earliest period. Then you're going to have to do 3 actuarial calculations depending on if you're a public company or not. Is there value to I mean, that's an open question. I'm not trying to lead the witness here. Or can you just do it at the beginning with a cum catch of the current period? So Jan 1, you would have a cum catch and so maybe that's modified prospective. I don't know.
Okay. I was just, and I'm comfortable with that, the optionality of retrospective versus prospective, but wanted to capture what I'm using the word modified, which is used in many different ways when the word modified is used, that it wasn't, through the P&L.
No, it wasn't intended to be that. It was just the acknowledgement that you might not want to go back for 3 periods, run 3 actuarial calculations for 3. So if I apologize, I might not have got the right words, but that was the intent.
Yeah, I can't really think of value in the prior year going back and doing actual. I mean, I don't think it's not value, but I don't think it's worth the effort to go back in that. And I'd be okay with the modified catch up as of this period.
Angie?
I thought what Paul described was modified retrospective. So it sounds like we all use different words. So just to make sure I understand. So Paul, I think you said, like, when I read it, I thought it seemed onerous to go back to the earliest period presented, but it seemed to make sense to me to get the balance sheet, like get the balance sheet right when you adopt. So
Right.
like the cum catch is appealing. But I thought did you say as of Jan 1, or we would do it at the end of a year?
We can define it however you want. I've modified retro, I've seen done multiple ways. And so,
Yeah,
I mean,
it's a bunch of, yeah.
right.
it's more
I
general.
just think we need to figure out what it,
Yeah, I like the cum catch.
Yeah.
well, but there's going to be a cum catch either way.
I'd like
I guess
it.
when I read
So do you-
prospective, though, I was worried that you drive on and then just the first
Yeah,
quarter you
that's-
read that, and
So-
that's why I read prospective.
Do
and
you
that's-
want the cum catch on Jan 1 or do you want the cum catch on December 31st?
December 31st. Yeah.
Okay,
Just,
then we
I mean,
just-
if we're dealing
Yeah.
with that second right there, I would want it to have the balance sheet point comparative with the next year. So at least there's the understanding of how that looked and went through there.
I mean, I think the board uses modified retro and then sort of defines it bespoke each time. So I think we've got latitude.
We certainly do not use the term modified retro or modified prospective the same. It is very much bespoke per project. So I think we're just trying to make sure we know exactly what words the EITF is supporting for purposes of going to the board. I know Jack has his hand up. We'll go to Jack first and then Matt.
Thanks. I know it's a non-starter because it's onerous and, perhaps, doesn't seem to be useful, but it's kind of nice to have as a user, the financial statements that are presented all on the same basis. So, I'd have to put my vote in for full retrospective, with the cum catch up at the beginning of the earliest period. Like I said, it's perhaps onerous, but it makes the statements have internal consistency and make sense in the presentation of them. Whereas if you make it optionally prospective beginning on January 1 or prospective in the year that you adopt it, I mean, you're going to have a lack of comparability across all companies for a number of years. So, if we're doing something that's meaningful enough to the financial statements, I feel like it's worth having for all the financial statements that are being presented. Anyway, that's all I got.
Appreciate that, Jack. Matt?
So I think some of this is similar to the discussion I think we had on the last EITF issue we met. And I guess my concern with retro and going back is, you get into different types of like predecessor, successor, auditor circumstances and consents and other things that just adds complexity. So, I understand that sometimes, it may be more comparable. You may always have to ask yourself the question, well, somebody may want to do that. So again, I'm probably in the prospectively, let's fix this. It makes it easiest. I think I don't remember exactly where the board landed on that issue, but I do think they also kind of, as we went through the retro perspective, thought about that as well. So the other thing I'll point out, and again, I just think I have this understanding right, so somebody can correct me if I'm wrong, but I think the old accounting would have captured the changes in discount rates and market returns and all the rest of that in the AOCI component. Now, when they go and do this, that's going to be kind of neutralized. And so, there'll be some complexity in kind of like what's in the opening AOCI and what had been historically. And, there's noise is what I'm saying. And so, I think we'll have to deal with that. I'd say rather than go back and do it all the periods and try to completely neutralize that, I'm okay with just saying, okay, let's do the modified retro and, take that opening kind of retained earnings thing and, hopefully be able to neutralize what is in the AOCI and not, I would say, captured, because I think most of the time these don't end up tripping the corridor approach. And so they don't end up, kind of burning that to expense. So I am a pension person that loves pensions. So, I think there's some complexities to think through when you think about the transition, the entries, the measurement, the calculations, that type of stuff. So, but.
Thank you, Matt. Rich, you had your card?
Yeah, just wanted to reemphasize Matt's point, because I heard end of the year, beginning of the year, and they're different, right? Obviously. And they will roll out through the pension calculation if they're not on immediate recognition. The other thing I'd ask the EITF, if you have any recommendation on early adoption, if you think early adoption should be whenever you want, any date you want to get an actuarial evaluation, or if you think early adoption should be, if you think it should be allowed, should it be consistent with end of year, beginning of year that you are just gonna pick? So.
Rich, is your concern on the early adoption that if someone says they're early adopting, they're going to get forced into 250? Because 250 would make you go to the earliest period.
I think our board sometimes lets you do it whenever you want in the middle of the year. So that wouldn't necessarily force you into 250.
You're just asking for clarity on that.
I'm just, if the EITF has a
Yeah.
recommendation
Okay.
on it should be permitted, and if so, should you have to follow the same beginning or end of the year mechanism that you've selected, or are you okay with them doing it at any point in time as long as they get an actuarial calculation? So just curious.
Brandon?
I didn't really have a view on early adoption going into this, Rich, but I just want to make sure we're crisp on the words, because when we say, through retained earnings, I don't think necessarily the cumulative catch would all go through retained earnings. Some of it might get caught in OCI.
Right.
So I think what we're just trying to do is establish what's the date you're calculating it at, and how are you affecting that impact? Is it 1/1? Is it 12/31? And I'm okay with permitting retrospective, but I wouldn't recommend requiring it.
Thank you. David?
Yeah, I've already said I'm the same on the thing. And when we look for the mod or full retrospective, it's generally related to income statement things that we're going to project, and we want to see what it did look like versus what it did look like. And here we're more on the most recent balance is our best estimate to go forward, and there's not going to be really predictable things going backwards and predicting this liability, because there could be a lot of external forces affecting it. I think it should be at end of the year because of the pension disclosures, and I like the end of the year. And so just, I'm circling in my head as well, but if it got adopted as of 12th, so the last 10K, the 12/31, 24, 10K, I would prefer the catch up was 12/31, 23, and is compared on the liability is correct, and then the income statement in the year of adoption is the income statement I will be accustomed to seeing in the future. And I like cleaning that out so that I can get more of an understanding of how this will work or the changes. And I think it's good to flush the confusion into the prior year on the retained earnings or AOCI or that type of thing.
Thank you, David. Do we think we have a clear understanding of what we mean by, because I currently don't have a clear understanding of exactly where the EITF members may be.
Well, I don't
Going
need,
with
I was wondering how you're going to tee up the alternatives at this point. Because I think there's probably at least 7 of them. Is
Yes.
what I've heard.
Well, let Jeremy go, and then I'm going to offer a suggestion.
I just give my support to what David said. This is a funded status issue, and to go back and restate the balance sheet for multiple years I don't find that to be very helpful. And just to flush it all out in the current year makes the most sense.
Appreciate that. It sounds like we do have a consensus or a majority that would agree retrospective should not be required. Full retrospective should not be required. Perfect. So I think we have that agreement. I think we agree that people could apply retrospective if they want. It sounds like we don't have any objections to if someone wanted to apply it retrospectively. So now we're just trying to figure out the wording of when we say cum catch as of what date are we talking about? Is that fair? Rich has a comment.
Do you want to just enable this to run through like any other change in a discount rate? And if so, I think that helps one thing. So just treat it like your discount rate changed and throw it into your actuarial assumptions. But if you're on immediate recognition, it would flow right through. And then just tell me the day you want to do it. Is that fair? Is that what the group was leaning to?
Mechanically, that's what's going to happen but I think we're just trying to figure out, and I'm hearing different things, is do you just want to wait till the next actuarial determination and run the rate then? Or do you want to then pick a different period and say, hey, at the end of last year, re-rack your actuarial calculation with a different discount rate? So I think this is that's sort of the question of, I think the choice might be, do you want to say that the next time you run a pension calculation, update the rate consistent with this? Or go back to the most immediate previous one, update the rate and record it then? I mean, I think that's what we're effectively really talking about is, like, do you want them to ever redo a pension calculation? If the answer is no, you just write the transition to say, the next time you do a measurement and you run your pension calculation, update the date consistent with the EITF consensus, and it's just going to flow through.
Right.
Yeah,
That would be
there's-
the pure prospective. That is prospective. The next time you do it, you adjust the rate. There's no cum catch related to that.
Yeah, I guess that's my
Yeah.
point is there's not a actual adjustment for the change in rate. It just flows
It
through.
just flows
So you're not
through.
going to see it
It'll
anywhere.
go into that
Versus if you
AOCI.
did it at the end of the year, I guess on a pure technical basis, you'd have the old rate. You'd have to run the old rate and
Right.
the new rate. And that difference would be reported.
Right.
Which adds some complexity, I guess, or.
So, I mean, 'cause you're asking, I guess what I would now lean toward as we've talked through this, and is I would just say the next time you run your the next time you run your normal pension calculation. So I would put words in the basis that wouldn't let somebody run a special pension calculation just to change the discount rate. But the next time you run the pension calculation, use a rate consistent with the EITF. That's what I would do.
And I just want to check on that, but I think that then would put that into AOCI and be brought into future periods as you burn it off. So it takes that differential change and puts it into future earnings, as opposed to one other way of adding the complexity that I was trying to kind of break out was say, okay, well, you kind of do a period, you say, okay, well, how do I isolate out what that noise and that change was? Don't put it in AOCI. Don't run it through future earnings if you trip the corridor approach or have it there stuck forever, right? You go back and you say, okay, how do I take the discount rate changes out? And now I just have actuarial changes in the AOCI component associated with, the likelihood that somebody, redeems earlier or takes annuities, that type of stuff. Again, I'm not trying to but I think that's the point or the tension that I was trying to highlight is, what do you put into that?
Thank you, Matt. Jeremy?
I'm good with Paul's approach. I mean, the reality is the volatility of the PBO and the assets and the actuarial assumptions is so high anyway. I just don't know informationally what I'm going to do with this data. I think practically we're talking about a gain here because we're reducing the PBO, and to throw that into the corridor and everything else versus running it through OCI now, I would just blend it in with all pension accounting. It seems to be the easiest.
David?
We take that all out of our income statement no matter what, so it's not a big problem for us. But I would be very concerned if auditors spent extra time on that number. I don't want this to, we have too many asks to be spending financial reporting time on that issue. So I would leave it to the, practitioners and issuers and people that know that better, whether this is going to become a problem in the financial reporting process, because I don't think the information is valuable to me as it comes out.
Okay, thank you, David. It sounds like we have two alternatives here. Alternative A, I'm going to call this alternative A, which is the next time you run your pension calculation, change the discount rate. That's it, full stop. Alternative B would be go back and rerun the last time you did your pension calculation, go back, rerun it with the new discount rate, and any impact would have to flow through in the period of adoption. So that's alternative B. Any other alternatives I'm missing that folks are interested in voting on?
Could we establish a new corridor somehow?
No, we cannot.
Okay. Then I have no other alternatives.
All right.
Second.
So with that, I will, unless there's anything else that we would like to talk about with regards to transition or effective date, and I will ask separately, I'm going to take let me call a vote on a few things. We're going to say that retrospective would be permitted, that early adoption would be permitted. And then I want you, I guess, can I get agreement with, do all of the EITF members agree with those two items? Retrospective can be permitted and early adoption can be permitted. Looking for show of hands here in the
Can you
room.
answer early adopted without the prospective all method? Like how do you?
Okay, we will separate early adoption. So then can I get agreement that retrospective is permitted? All right, everyone, perfect. So everyone agrees with that. Now, if we're talking about a alternative A, so next time you run your pension calculation, change the discount rate is alternative A, and alternative B is go back and rerun your last pension calculation with the new discount rate. If I can ask for votes, I will just go around and ask for votes with regards to whether you're alternative A or B on that, starting with Matt.
Microphone, sorry.
I would be B, but I am fine with A. I wouldn't object to it. So.
Okay. Angie?
The dork accountant in me has to go B, but I appreciate that A is simpler. I think it would be a good question
Okay.
in the ED.
Jeremy?
A seems simpler. I honestly, if the accountants want to rerun everything in that way, then by all means, but usually the roles are reversed.
Kate?
I prefer A just from a practicality of approach perspective.
Okay. Dan?
I support A, but would be fine with B.
Kevin?
View A.
David?
I'd probably be B, but I'm not as, I mean, and it has most of my input, but this has nothing to do with the information coming through to us. Like, I don't think it's in one way better for me. It's just about the work and practicality of it. I would err on.
Okay. Brandon?
Well, I was going to give a big speech before I said B or A, but I mean, I came in B, but then David kind of, something he said made me go A, but then he voted B. So it mainly because I was worried about like an immediate P&L impact. I think FAS 158, I don't think that option existed. So they did A, I think, but it all went through OCI. So I will vote B, but I also couldn't object to A.
All right. Jack?
I prefer view A.
Paul?
One clarification, it's not the accountants that run this, so this is whether the actuaries
Okay.
get to run another account. So, not strong feelings. I'm just going to go A because I think it's a lot simpler. And I just heard two people tell me that they're not going to use the information if we do B. So,
Okay, great. And Tom?
That's where I'm at. I'm at view A. I'm not sure what anyone would do with the cumulative effect information, given the number of changes that change every period with these plans. Like that isolated information to me is worthless.
Okay.
But wouldn't be opposed to be.
So it looks like we have 7 votes for view A, so we will go forward with that as the recommendation to the board. But we need to come back for early adoption. So again, I know Rich had highlighted if you have any strong feelings with regards to early adoption, in which period, does that need to go back? If you early adopt in a interim period, do you need to go back to the earliest period presented within the year, as at the beginning of the year for purposes of adoption? Or should you be able to early adopt in an interim period understanding that you could have then a difference if you adopt it in the first or second quarter, right? You would have a disconnect between those quarters if you're a public entity.
And-
Rich,
And since you just voted for
Yeah.
anytime you do an actuarial
it goes
study,
forward. Yeah.
do you mean you can early adopt it anytime you do an actuarial study? I think that might be the other way of saying it,
Okay.
meaning it doesn't have to be your annual.
So would everyone agree that you can early adopt the next time you do your actuarial calculation? Is that all?
Well, I feel like we're starting to split hairs here. And I had mentioned this, but I would have said the next time you were scheduled to do one, like I generally feel like early adoption, but I don't want someone to wake up on January 10th and go, hey, I'm going to run a pension calculation. Like, that feels a little disingenuous. And so if we can put words around the next time you're scheduled to do, like, I just don't want it free for all.
So I think unfortunately our pension guidance says anytime you have a more recent calculation, you have to use it. So just as an aside, we don't have parameters around updating pension assumptions.
Yeah, I guess
That's
what's the concern if someone's going to rerun the entire thing? I think it's important they rerun the entire
They have to.
calculation, not just the discount rate, which I think is a critical piece of it. They do it. You know, that's the best estimate at the time. I don't see why we wouldn't allow them to do it.
So would anyone object here to saying you can early adopt the next time you rerun your entire pension calculation? Okay. No one's objecting.
Just like practically what happens then? Like, we don't have, like, if it's as of January 10th.
I think, David, it would be depending on the effective date. So if the effective date goes out a couple of years, let's say,
Yeah.
and that would have to be a decision by the board, that staff will bring that back, but someone could adopt it a year earlier, right? Or the next time they're doing their calculation.
No, let's be clear. The way it's going to be drafted, we're going to say early adoption. The next time you have a pension calculation, somebody can wake up one morning and run a pension calculation at any point of.
Yeah, I'm asking about the financials. So like Q1, I get it.
It'll flow through in that
but
period.
what
In that
information
period.
am I going to get? Like, that's the part I don't understand the disclosure as much, that like if that annual disclosure that I rely on has a change in Q1, will that give me enough information to understand?
It's the same thing you get today if they redo their pension calculation.
Okay, so I would get the
mid-year.
information that I
They're
get.
going to look at the principal and decide what has to be updated on their pension disclosures,
Okay.
right?
Well, if they do it at a quarter, they're probably going to have to pull in the year-end disclosures because they
It's a
rerun the
significant
calculation.
or whatever
Yeah.
event that changed, and so they
Yeah.
have. I just wanted to make sure that
Yep.
information was there for me, because I don't.
It will be.
Sometimes when pensions change, we have to make assumptions that are non-public or things like that, because we have the annual disclosure. I just wanted to make sure that we're accurately incorporating it.
I guess I just to chime, I mean, I like the simplicity of it and it makes sense, but at the same time, this is going to be such a non-visible change in a lot of ways, right? Because we're doing it prospectively. You can do it early adopt, you can do it whenever you want. And so I just feel like for a user, it's going to be really confusing. We're just going to have people adopting at all kinds of different times and different periods. And I appreciate the disclosure that on the change in accounting in the period, but I don't know, it just seems to me it would be more elegant to at least get everybody on the beginning or the end of the year, would just be my thought.
Based on this discussion, does anyone not support early adoption anymore? No. Okay. So it sounds like we still have early adoption on the table and early adoption the next time that you run your pension calculation. Okay, that is the recommendation going to the board. Obviously, we will make that wording a little bit more clear and specific. And there will be, transition disclosures will also go to the board to ensure that investors are best able to understand that something has happened, right, with regards to the change in the accounting. So with that, I believe that is the end of our decisions related to this issue, but David still looks like he has something to say.
If you don't use the corridor approach, you have a significant gain when you do this, right? Is that right? And I don't know if that was really discussed.
Won't that depend on other changes and assumptions?
In isolation, yeah. I just like in relativity to OCI and all these movements and pensions, this might not be a big deal, but in relativity to a current year income statement, this could be. Like, I don't know if that was clear.
So David, if you adopted a change, right, chances are, and our board would discuss it, you'd do the 250 disclosure requirements requiring you to describe your change in accounting, right, including adoption of a new standard and what the effects were. Plus, if you had if you had anybody today who's doesn't have a quarter approach who redoes their actuarial evaluation, has something fall out, I'm assuming they disclose that.
Yeah, I mean, like I said, for us, it's not a problem, but I just don't want spikes in earnings that are not well understood of this. That is a factor that could happen.
They'll just non-gap it out, so you're good.
Well, we will. I just don't want to. Like,
Yeah, I mean, that was my view be vote, and that's why I said, like, when you said you're going to non-gap it out, and I said, well, maybe
Well,
view
we're
A is
definitely
fine.
gonna we do that. We take the approach of service cost as our expense, and we remove all the noise.
Yeah.
But we have a liability that we monitor carefully, so we don't need all that. But it's just there's always two hats I'm wearing: what Moody's does, and what, as just a user, I might be misinterpreting. And that just the spikes in income is something that can be, depending on interest rates, probably even a little bit cherry picked when you adopt.
All right. Perfectly clear, as always. Transition and is always the most challenging part of any meeting. So glad to see we're continuing that tradition. That's at our own board meetings as well. But really do appreciate, I think this is a really good discussion today, being able to get through this issue. I thank Paul and his team for a great issue summary and a great discussion here today, and for everyone just actively engaging to get to a good answer that's going to come back to the board for a recommendation to add to the agenda. So with that, I will turn it over to Alana for a few announcements before we close the meeting.
Thanks, Hillary. So based on the EITF recommendation, the FASB staff will prepare an agenda decision memo for the board to discuss at a public meeting. The agenda decision memo will include the materials discussed by the EITF, a summary of EITF decisions, the basis for the EITF's recommendation, and analysis of the FASB's agenda criteria. The board will discuss the issue at a public board meeting and determine whether to add the project to the FASB technical agenda. As a reminder, our next regularly scheduled public EITF meeting will be Thursday, December 4th. We will be sending out an email to gather your availability for scheduling the 2026 EITF and Agenda Committee meetings. With that, I would like to thank everyone for their active participation, and we are adjourned for the day. We will see you at our next meeting.